presentation contains current opinions of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that those opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation.
Hello everyone, and welcome to the Compact Market Wrap update for June 29, 2026. I'm Moe Ansari, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President. We're going to talk about the markets, what happened today, what to expect next week, and in between, whatever you want to know. You can always send me an email, and we will be more than happy to answer your questions, also any of those that you have. Also, a housekeeping note, subscribe to this channel. Whenever I do an update, you'll be notified, and you can watch it at your convenience, or you can go to compact.com, click on Insights, and you can see all the episodes there. If you need help with your portfolio, give us a call at 800-388-9700, or just send us an email at invest@compact.com. The book launch is coming. Javaid, I'll let you talk about the book.
Yeah, the book, in a couple weeks, July 14th, we're having a kickoff event at UC Irvine. Feroz is also a professor at UC Irvine, so they're doing a kickoff event for some clients. And so been really enthusiastic about the book. I've been talking to clients about it. I think the wealth part, we do pretty well here at Compact. That's why we're registered investment advisors, fiduciary advisors. But I think combining that with wisdom is really what makes the book really unique, where Feroz really talks about knowing yourself, knowing the world, and knowing your purpose. And you really have to understand those components to then understand, okay, why are we creating this wealth? How can we put it to the best use that's going to give us the maximum enjoyment during our lifetime? So you have to really look at those things holistically. I think it's a testament to our holistic approach of wealth management here at Compact Asset Management, and now available to all of our listeners to really, if you aren't a client, you can at least get a little bit of a feel for how we go about. And I think this is going to become this broader conversation around holistic wealth. You're going to hear more of this as Compact's not the only wealth management firm looking at this type of orientation in terms of holistic advice, but you're going to hear a lot of other advisors over time really move up the value stack and really see how we can provide really positive outcomes for our clients beyond just managing the money.
That's really important. I mean, 20 years ago, 25 years ago, when I started talking about financial planning, people said, why do I need financial planning? Mm-hmm. All I need is asset management, what stock to buy, what bond to buy, how to allocate, and so on. But then everybody realized how important financial planning was. But now, after a while, after doing this for nearly 40 years, I realized, okay, now that we're at a point where you've created wealth, what is it for? What does it mean? Getting there, I know, is very, very important. Creating wealth in the first point is very important. That's our job. But once you get there, what do you do with it? What does it mean? How does it provide you happiness? How does it provide people around you happiness? Does it make them happy, or does that make them miserable? I've seen people with a lot of money who are really not happy, and I ask them why, and you get all different answers. So combining that meaning of wealth, meaning of how you handle it, and what is it for once you have enough, and realizing when is enough enough? That's one of the hardest questions that a lot of people just don't know the answer for. They always are looking for more, but if you already have enough, what's the point in having more? If you have more, what are you going to do with it? And those are some of the questions that I think holistically you have to look at it. And very few advisors really have that depth of knowledge, the depth of experience to provide you with that wisdom, as we call it. So that's why I think the book is really combines all of this wisdom and wealth. So it'll be coming out on July 14th. You can pre-order it now on Amazon.com, or just go to wisdomandwealthsolutions.com and you can order the book now. But the book launch, July 14th, at the University of California, Irvine, at the Business Auditorium. I know hundreds of people are going to be there, and come on by if you want to come there. It's all free, and it's at the UCI on July 23rd?
July 22nd, yeah. If you'd like to get information for the Wisdom and Wealth Solution launching, Butch launch here at UC Irvine, just shoot us an email, invest@compact.com. We'll be happy to provide you the registration link and meet you in person.
Yeah, I will be there. Feroz will be there. He's, as you know, also an adjunct professor at University of California, Irvine, at UC Irvine. So we'll all be there. Stop by, say hello, and you can see the book launch. And he will be there, and I think a lot of the staff from the business school at UCI is going to be there also. Let's look at the numbers. Not a good week in the markets last week, Javaid.
Pull back. I mean, we had an incredible week the week before, but S&P down 1.94. Dow was up 0.6%. Russell was up 1.03. Growth stocks really took a beating, down 3.4%. EFA down 1.3. Emerging markets down 4.44. And then finally the Nasdaq down 4.6%. So, like I've said, emerging markets, they're kind of very correlated now to the AI trade, and so clearly AI was taking a breather. Just kind of looking at some of the things that might have kind of precipitated or caused that decline. Both Apple and Microsoft raised their consumer prices on Thursday, so they're citing
iPads, Macintosh, all went up.
all went up. They're citing, with the AI chip build out, memory and storage chip costs have gone up substantially from last year, and they continued to go up all the way through the end of next year. And so that's why we still see the semiconductor index doing extremely well, yet some of the now down the kind of stream type of people who make the phones, right, or provide a lot of the services, they're now having to increase their prices, and there's a little bit of trepidation as it now costs $2,000 for, starting to get closer to $1,000 for a new phone. I still feel it's fine. People, they're glued to their phones. It's
I think it might hurt the upgrade cycle. Well, people say, well, I've got a phone here. It's only a year old. I don't need a new one. It's more like the computers. I remember when we had the XT, and I know a lot of you don't remember
XT.
IBM XT, and then they had the AT. I know you don't remember those, but about 40 years ago when they first came out, every time you got an upgrade, it was a substantial upgrade. Then the AT and then the 386 came out, and it was a lot faster, and the speeds were a lot faster. But once you got to a certain speed in computers, you just didn't need any more faster speed. It was good enough. Then you just wait till it broke or whatever happened to get a new computer.
Yeah.
And I think that might be the way that people might say, okay, unless it's a radical increase in speed or some kind of usage that you have out of it, it might slow down the upgrade cycle. I don't know. We'll have to wait and see. But it could impact that a little bit. And as you talked about last week, the emerging markets were down 4.44%. And some people called me and said, well, why did emerging markets go down? I said, basically, it's become just like the NASDAQ, the emerging markets, because two of the largest stocks there are Samsung and Taiwan Semiconductor.
And SK Hynix, which is also a big South Korean chip maker as well. Yeah.
So it's basically chips or tech. Also, you're talking about price. People are starting to worry about the AI pricing too.
Yeah, absolutely. So we talked about a little bit last week about how OpenAI and Anthropic, right? These are the two biggest unicorns right now. Valuations almost close to $1 trillion. These two private companies,
right.
And if they were to go IPO, now we'd actually have a true proxy for the value of these AI models, right? Because that's their business, right? They provide the models. Well, how do they monetize those models? Well, they charge tokens or usage to primarily corporations, and particularly Anthropic really kind of led the way in terms of providing more of that corporate exposure. OpenAI, they went kind of first to the retail. OpenAI really started everything back in November of 23. But now some of these corporate consumers, they're starting to have a little bit of, the amount of money that they're investing in AI and their personnel is using all these tokens is now starting to reach maybe an inflection point or a pain point where now they're saying, you know what, we're not going to use it anymore. In fact, Microsoft had news, their experiences and devices division. So this is the division of Microsoft that makes Windows, Office, Teams, Surface. Basically, I think, as we think of Microsoft from the consumer level, the major pieces, of course, Microsoft has a whole cloud computing business, which is incredibly profitable. But they were instructed as of tomorrow, June 30th, to stop using Anthropic's Claude Code. And the reason for that is because it's incredibly expensive. It's blowing apart some of the budgets of some of these engineering departments. And so what's then happening is now we're starting to potentially see a price war between OpenAI and Anthropic regarding the usage and the tokens. And so that's not, once again, you have that competition. And I think that also dovetails into some of the news today that OpenAI might be delaying their IPO till next year. And and I think the reason behind that is because they don't want to have this transparency and a stock price fluctuating every day for people to kind of, if the stock price tanks, it kind of then, OpenAI and AI starts to lose its allure. And right now it's in the private markets. You have
Nobody
all these
knows exactly what
no
it
one
is.
knows what it's really worth. Now we're seeing a little bit of that with SpaceX. SpaceX came out. SpaceX is not AI. SpaceX is basically rockets and satellites.
And a
Yet-
Starlink, basically.
Yeah, that's the satellite component.
Right.
But it's trading at 90 times revenue, incredibly expensive. And so now you have a direct proxy for that type of industry. And so, it makes sense to me that they would potentially want to keep this as private as long as they can. But at the same time, markets are really nice right now. We're looking at cumulative returns on the Nasdaq has been 94% over the last 3 years. The market's gone up, and Nasdaq's gone up almost 100% in the last 3 years. They're treading a fine line here, and I think it's going to be interesting. And so with that, last week we saw a lot of rotation out of the Magnificent Seven, some of the bigger players, into some of the small cap, Dow type of names. More value, was outperforming. So I think that's a positive shift. It's not a risk-off shift. And so we're seeing that rotation. We've seen these rotations before.
Right.
They tend to last for a little bit, and then they revert
but look
back.
at value. It's up 16% this year. S&P is up 8 as of last week.
Well, and growth is only up 1%.
Yeah, that's
And everyone was growth. I only need growth now.
Yeah.
I only want growth. Give me just growth. I
Yeah,
don't want to see
exactly.
any value. You haven't made any money this year.
Yeah, so if you look at the S&P, a broader index, the S&P 100 or the S&P
500.
500, but even the broader index, which is value rather than growth, it is doing very well. So something to think about. And again, we talked about this balance
Yep.
that you have to have in your portfolio. Don't get enthralled or pulled in by greed. By, boy, I got to have this because it's going to be the next rocket launch.
Or
and
if,
it's going to be.
or if you've been fortunate enough to have it, doubling down and just continue. You get the paycheck. I'm just going to buy more NVIDIA, or I'm just going to buy SpaceX, right? Eventually, everything goes in cycles. That's what we talk about here with the technicals and the Elliott waves and all of that. And so I think now, as we've been saying, now is a time for diversification. Diversification is working. You're still making money. Small cap emerging markets are up 22%. Even EFA is outperforming still year to date, even though they've had a really tough situation with the Iranian situation, energy, and then Russell up 21%. So the more diversification you have, it gives me, when I look at growth only up 1% this year and value up 16, it does have that mini 2000 feel to me. Because if you look at the market between 2000, 2001, 2002, really when you were advocating sell all your stocks, right?
Sell all the tech, the .com will be gone.
Gone, and that really put us on the map here at Compaq almost 26 years ago. But it kind of has that little bit of inkling. When the valuations get this high, they only can go so high. And so then, if you had value during 2001 and 2002, you still did very well.
Right.
But it's very difficult to kind of get off the addicted to some of that growth return because it's been so fantastic and make the transitions. Or maybe you have a lot of unrealized gains in your non-qualified accounts. You can't really sell because you have to pay a huge capital gain. And then to make the change, well, that's when you need to look at things holistically. Look at your retirement accounts, maybe balance those out because you can make changes there and you don't have any capital gains. So
Even with those capital gains, we do have some solutions for those people also
Of course.
who have large capital gains, and we can help you diversify without paying the capital gains. But that is, again, a very complicated process. It's something that you need the expertise, you need a financial advisor to help you go that. But if you're sitting on one stock that you've got and you're just sitting in that one big company stock that you've accumulated over years, now you're worried because every time it goes up 10% or down 10%, you see the move in your whole value of what you have, your net worth going up and down like a yo-yo, and you don't want that. You want stability. Once you've made the money, the trick is to keep the money. It's not what you make, it's what you keep that counts in the long term. You've heard me say that for 30 years, and I'll say it again. Let's look at last week. The healthcare sector was, again, defensive sectors, real estate, utilities, and the ones did not do well, the textile.
Yeah, so healthcare, I think, healthcare specifically, I think pharmaceuticals is a place to look. I've liked biotech. I think biotech is going to benefit a lot from AI with the research and the ability to really leverage AI to kind of run a lot of these trials and get much more efficient in a highly speculative type of market. So healthcare definitely bounced back. I just want to mention one other thing. Yeah, China. I know we'll talk a little bit about China because I think it relates to oil as well. But another news we got from Microsoft is that they're thinking about using DeepSeek. Remember DeepSeek? It came out, it caused a big kind of correction. I think it was January. It was January 25.
Isn't that a Chinese model?
Well, it's a Chinese model,
Right.
but it's cheaper, powerful, but it's open source. So
Right.
it comes out of China, but it's not really like Chinese per se.
Again, you talked about this again last week, open source and closed source.
Correct. And so now because the closed source, these companies are trying to gouge the corporate consumer so much, people are saying, yeah, we like AI, but we have this alternative over here.
Maybe we
and
don't have
it's-
to pay for it.
We don't have to pay for it. So then, how does the regulation and all that play out? So I think that's a big question mark of the feasibility or the profitability of the AI models, where it's just like the internet, where everyone's got access to it. You can't profit of just having the internet. No one owns the internet, right? And
Right.
so AI might be going down that similar route. So it's something to, and once again, until we have Anthropic and OpenAI public.
But how do you monetize it? How does Anthropic and OpenAI make money or justify the valuations? Put it this way, they
They're
will
gonna
make
make
money.
money.
Yeah,
Yeah.
they're going to make money. But how much? And as you've always heard me say, show me the money. At the end of the day, show me the profits. How much money are you making? The more money a company makes, the more valuable their stock is. But if the expectations are here and the amount of money being made here, then there's some problem here. There's a lot of air between here and there, and that's where I think the valuations come in and you have to look at it. That's where diversification comes in. So China also has a situation with oil that everybody was worried about. Oh my God, the Straits of Hormuz is closed, it's going to kill the Chinese economy. But it didn't. What happened?
Well, Chinese crude oil imports fell to 4.6 million barrels per day in May. And that's, on average, they are importing about 6.6 million. So it's about 2 million barrels of oil that China wasn't importing in May.
40%.
40%, right? And a lot of that has to do to the Strait of Hormuz. Well, you would think, wow, then that's going to shoot up prices. Well, it didn't shoot up prices because China, just like the U.S., went into their stockpiles of oil.
The SPR.
Yeah, they're strategic. So those
reserves.
strategic reserves are low globally now because of the situation in Iran. And who knows? I mean, we had a flare up. Now they're saying there's a truce again. But this is what I always said. I don't know, unless in my opinion, unless a couple of $100 billion is being given to the Iranian Islamic Republic of Iran, the Strait of Hormuz is not going to open. And so I don't know if that's feasible, if that's actually politically feasible, if that's going to happen. But I still think it's still somewhat a little bit
The Iranians have said, hey, we don't need the nuclear bomb anymore. We've got a bomb on the economy. We can control the global economy now with the Straits of Hormuz. I think they can only use this for a few years if they start charging a toll, because everybody will build pipelines to go around the straits. That's what they'll do. But that doesn't happen overnight.
No, it's going to take 2, 3, 4 years.
to change the whole way the oil is shipped through the Middle East. And there's a lot of other choke points in the world that people are starting to look at.
Well, the Red Sea is very similar off Yemen.
And then there's the Straits of Malacca off Malaysia and China, and they're worried about that. So, if you start getting into people charging tolls for any time you go through a strait, which is international waters, by the way, by UN charter, nobody can charge a toll. But hey, if you can charge a toll and get a few $100 billion a year from people from around the world, why not? And the Iranians are realizing that they have a bigger weapon now than a nuclear bomb. They have a weapon to control the global economy.
Exactly.
And that's where I think, I think we're going to figure out a deal to figure out a way to give the Iranians what they want now. So we keep the straits open. That's really going to be the key. And we'll see how this, every weekend there's this flare up, and then everybody says they're going to talk, and they talk, and then Friday they go and bomb each other. Then before the markets open on Monday, they come with a peace deal. That has sort of been the cycle that we've seen. But what is the long-term solution? We don't know yet. No one really does. And this is a situation that is going to be persisting for a period of time. It's not going away.
Well,
anytime
and
soon.
I think just to tie it back to oil and China, I think China's in a tough spot right now. They're experiencing a property bubble on the scale that we had in 2008.
Right.
And this has been going on for a couple of years now. And so their economy is not great. And I think oil prices ultimately might be coming down as well, not because the Strait of Hormuz is like hugely open. It's kind of open, and we'll see here going forward. But it might be oil prices might be going down because China's slowing down, and I think that's also playing into it. So you always got to be careful. We like lower oil prices, we like lower interest rates, but we like those when things are becoming more productive. We don't like those if we're starting to see economic slowdown across, and once again, the three major economies that we always focus on is China, Europe, and US. And so if China, starts to, experience something, that could also raise a little bit of their potential to do something geopolitically as well. So,
and it's sort of, now they're all interrelated to a
Correct.
certain extent. So it's a three-legged stool. If one leg breaks, it's hard to just balance on two, put it this way. And that's where
Europe's not really strong, and so then it all goes back to the US.
And that's really the problem. The U.S. cannot just, it used to be just the engine of the world economy. The U.S. economy got a sneeze, the whole world got a cold. And that's the way it used to be, but not anymore. It's sort of China, Europe, and the U.S., all three combined, make up the global economy. Emerging markets always, there's a small part of that. But those are the three, and if China slows down radically, dramatically, it could have a knock-on effect to what happens to the United States and what happens to the European economies also.
Yeah.
We'll have to wait and see.
I don't think it's as much. It's like, because Chinese consumers are not, it will have an effect, but it's not U.S. going into a recession. U.S. goes into a recession, the world's going into a recession. But.
Oil has come up a little bit last week, but not much. It's still around $70 a barrel.
We'll take a look at the DBO chart and the technical analysis. And once again, if you're listening to us on the podcast version of Market Wrap, we have the YouTube version, which you can see all the charts that we're alluding to through the presentation and there. So we'll talk. DBO got below my 19. So the futures have come down. So we're getting a little bit of hopefully gasoline price relief. My son today, I was dropping him off at summer camp, and he was mentioning, he was looking at, it was at Union 76, and he says $539 per gallon because it didn't have the decimal point. And I was like, yeah, it's high, but it's not that high, but it's still $539 here in California. So no relief for the Californians, but it's still pretty high. And so I think we'll just kind of see where things go. But if there's another huge flare up again, I don't think the Iranian conflict pushes us into a recession. But I think it does have an effect a little bit on interest rates. I think it caps the upside on the market. I don't think it creates more downside in the market. I think the market's gotten used to the situation. But I think if there is a continuing ongoing problem, oil prices remain elevated, interest rates remain elevated, it's going to be really tough, even though AI is fueling things in the AI infrastructure, for the market to go higher.
Interest rates were down last week. They came down from 4.46 to 4.38. And the market was down. I like to see when interest rates come down, the market going up, usually.
Yeah, it's a little bit, I would say risk off. High yield is down slightly, 0.06. So yeah, definitely aggregate. Bonds did very well last week. They were up 0.5, 0.5% last week. They're kind of been flat this year, but still yielding. You look at corporates are yielding 5%. A lot of the times when I'm doing financial plans, all we're looking at is 5-6%. So right. you can get your yield just in fixed income. You don't have to worry about all the volatility in the stock market. So I think, we'll kind of continue to monitor it. But yeah, bonds, once again, you had some time to rebalance your portfolio, maybe put some of that cash to work. That's what I said. Don't necessarily put that into stocks. instead of having, if you have a bunch of cash, buy a bond ladder and you're already up a couple, 3-4%. Basically, an entire year worth of cash, you've already made it here within the last couple of months.
This is an interesting chart. It shows that the amount of money needed, when you combine it, what do you need to buy World Cup? Well, World Cup tickets.
This is inflation.
Yeah.
Yes, cumulative inflation from 1994. So that was the last, I think, World Cup. We had 94 World Cup in U.S. to now World Cup in 2026. So World Cup tickets are up 1,600%. And this kind of goes, I mean, that's just an exaggeration, but I think a lot of that has to do with FIFA and how they're trying to price everything, they're trying to bump up their revenue from $2 billion to $3 billion, and they're gouging everyone to do that. A little known fact about the World Cup, it's actually compared to the Super Bowl. Like we think Super Bowl, that's it. That's the ticket, right? That's the biggest sporting event of the year. The World Cup, from a viewership standpoint, is 104 Super Bowls in 1 month. 104 Super Bowls.
Wow.
So when you start to, I think that's really powerful because it really starts to kind of put even the U.S. kind of sports market, just the U.S. market in the scope of the global market, about how big the world really is when it comes to, in this case, viewership. You know, markets and those type of things, U.S. makes a much higher percentage. But when it comes to eyeballs, right, we're only a portion. And so I thought that was pretty interesting. But I think one of the key things from this chart is, home prices have continued to go up faster than wages. So I think that's just difficult, over the course of the last 20 years. People are making money, but they can't necessarily afford a new home. That's, I think, tragic because we all need to live somewhere. But wages have still gone up higher than inflation, so that's real wages. So the 185 versus 123%.
Yeah, wages.
So people are still doing fine, but I think housing affordability is a big issue. And so, and I think there was even wasn't there some bipartisan? It was a little surprising. There was some bipartisan legislation that got passed, and then the president didn't sign it because he was kind of holding it up. I think he wants to tie it into kind of voter ID for the midterms. And so, I would take anything that is somewhat of a compromise between. I mean, that's one thing I think Democrats and Republicans can really agree on. Is the rent's too damn high.
And usually they can't agree on anything.
Correct.
But they agreed on this, passed the bill, what they'll also do want to curtail corporates from owning too many
private equity kind of going in and
buying all these homes and saying, okay,
renting them out. Yeah.
Renting them out, and they were charging a lot more. This week, the employment rate data comes out, but it comes out a day early.
Yeah, well, happy 4th of July. I know everyone's now 250 years, right? So it's I guess it's a bigger year than most, just because it's a round number. But we're celebrating it, and so Friday is the
markets
observance.
Are closed.
Yeah, markets are closed on Friday. 4th of July is on Saturday. So we'll get the employment number on Thursday. Employment number has been looking good. I mean, everything has been looking really nicely there. I think people will be looking at average wages to see if that's going up. Sometimes wage inflation can feed into inflation. All the studies, this goes back to COVID, really inflation drives wage inflation, not the other way around. So once you start having money printing and a lot of monetary inflation, then people have to catch up because their dollars get cheaper. So then their paychecks go up nominally, but when it comes to relative to inflation, they're really just keeping up with inflation. So, and then I think the only other data, I think we can go to the next chart, but we have the PMI, manufacturing PMI, which is coming out, but manufacturing's been on a tear.
Yeah.
Above 50 and will continue with all of this AI investing. So I don't see the AI story changing from an investment perspective anytime soon because that build out is still happening. It's going to continue. But if we start to see some more competition around the monetization of AI, that could then feed back into the build out of AI, and then that can feed back into the economy. It's going to take time. It's not going to happen overnight.
Right.
But I think that's one of the things that we're watching really, really closely here, and we'll continue to monitor.
If they have to stretch it out over a longer period of time, all the build out slows everything down, and that slows down profits basically.
Yep.
And then you look at companies that are not AI related, and that's why a lot of people are starting to look at value and starting to move money over there. Technically, market came down again last week, popped back up,
Got below the 50?
got below the 50 for one day, basically right at the 50. Today it's right back above the 50 and back above the 20-day moving average. So this was the fourth wave pullback right here. Now we're looking at the fifth wave to the upside, and that should take us to 7,900 is the target.
But most likely this fourth needs to chop around for a little
Yeah,
bit longer.
usually fourth waves, as I've said, chop around for a period of time. But if we break out above here, which is also here, then we're headed there, which
So
is
that's
7,600.
7,600. Yeah,
Right,
well,
so-
of course. Yeah.
Yeah, we're 74, which is all-time high.
All-time highs, yeah.
We to break out above that, then we're on our way. But it might just chop around here in this area for a period of time. That's the way I'm looking at it. Long term, we seem like we're completing a fifth wave. Doesn't mean this is the fifth wave. It could go up. We'll go
could
up to
extend a little
78.
bit
Yeah,
more.
extend it a little bit more, and it could last weeks before we make a top. if that
So you just got to be cautious. Sorry, one of my analysts here, he showed me he was like I think it was on Reddit. I think there's Wall Street Bets, which is like one of the big Reddit channels where everyone's getting all their stock advice. Great, but one guy I think he posted that he put his entire Roth IRA. It was like $300,000. The guy's probably saving for a while, all into SpaceX at 211, which he picked the top. so his Roth IRA is down 30%, almost $100,000. He's lost in about a week. So you just got to be careful. There's a lot of enthusiasm out there. I don't think people listening to Market Wrap are maybe getting caught up into that. That's why they're listening to Market Wrap. They have good sense. But it's just if you are new listeners, hopefully you're getting the message.
And chasing this and chasing that and every shiny thing that comes along, that's not the way to create wealth. Create wealth is having a plan, having good diversification, make sure you know what your goals are. Doesn't mean you can't be aggressive, you can, but getting overly aggressive is the problem.
Yep.
And that's where people get caught up in greed, and that never pays off. NASDAQ daily.
Looking much weaker though.
Yeah, it has, but today it's right at 2508, 2513. Is that where we closed?
On the NASDAQ.
801. I think I just did this a few minutes before the close today. I think
NASDAQ was 25,820.
820. So we just closed above the 50-day moving average, which is 25,813. But we need to get above 25.9, or really 26. This gap right here needs to be filled, which it usually does. And then we might chop around again in the fourth wave before we can break out to the fifth wave top. That's on the dailies. On the weeklies, we made the fifth wave, looks like. But again, this could, extend a little bit more. It takes weeks and weeks and weeks, which could be 2 or 3 months.
Well, and that's why I'm kind of really continuing to watch the bond market. We'll show you our HYG AGG chart, because I feel like if that starts to show a little bit of weakness in this kind of area of these fifth wave weekly tops, that might be a time when you really want to just make sure that you have your ducks in a row for what might be coming. But until then, we just continue to let it roll.
Enjoy the ride.
Yeah.
Don't try to over analyze it. Don't try to overthink it. Just make sure you don't get out of balance. That's the hard thing. Don't use your balance, because that fall hurts. Put it this way.
Well, and I think just a lot of people are just, the headlines are concerning. You can't, but you got to understand the headlines used to be, Walter Cronkite and these great news journalists of the day, it was news.
Right.
They're really trying to cut
Dan
through.
Rather.
Dan Rather really tried to cut through, give you the news. Now, it's more entertainment in my view, and it's just really sensationalized. It changes every day. It's really there to get you emotional, to get you to tune in, to get you to click. It's not there to get you good information. And that's why I really like the markets, because the markets will tell us when we need to really sit up and be concerned. And we'll tell you right here on Market Wrap when you need to be concerned, because we're monitoring it, but it cuts through a lot of that headline noise. And I think that's really important to kind of remain, somewhat objective as best you
I'm
can.
tired of this breaking news. Everything is breaking news. I mean, oh my God, they had a cloudburst.
I got to
of
turn
rain.
off those notifications on your phone.
And
That's what I gotta do, yeah.
Breaking news. I said, oh, it must be something important. Oh, we had rain. I said, okay, we had rain. So why is it breaking news or whatever? I mean, everything is breaking news now.
Yeah.
Whenever something comes out, and like it's the end of the world, and then you realize it's nothing. It's just that they want you to come there because they want the clicks, they want the eyeballs, That's all they're looking at right now. ETF, the international market, back a little bit down. But again,
Still
this is a
looking
weekly
strong.
chart.
I think this is kind of you look at both this and then the previous chart, the IJR.
Yeah,
You know, it's
small
all
cap.
looking relative. You know, it's kind of that broadening out, which is really healthy. So can't
these-
question it, and we just go along with it.
Go along with it. This is the
Go
oil
maybe
chart.
go to the daily, maybe on the
This is
on
the
the
daily.
DB previous.
Oops, I don't know if I have a daily.
No, you had it.
Oh, here it is,
Yeah.
the daily chart. So we're starting to back off a little bit on oil. We
Oh
need-
no, that's IXUS. Yeah, go ahead. Never mind. Fast
yeah,
forward.
that's what I
Yeah,
thought.
here's the weekly. Yeah.
Weekly chart right here, and it's come down a lot. You know, we broke below this 19. area,
19 was my level.
Yeah,
Yeah, so we're
that's the
sitting at
20-day moving
17,
average.
which is great.
and now we're at 17.74 on the close today, or
Mm-hmm.
right about there. I think this is a critical area right here, around 15, 16.
Oh, I think you go back and you look at some of those previous highs that were
Right
kind of
here.
made during the original Ukrainian invasion,
But that's right here. It's at 19.
Yeah, exactly. So now those are now more resistance to the upside.
Upside.
So yeah, it seems like that somewhat of that situation is coming to an end. I'm still. It just depends on how much we're willing to give the.
I mean, nobody
Iranians.
cares if we bomb each other for the weekend. They bomb fuel.
Well, I think the question is yeah,
the
maybe
Straits of Hormuz, is it open or closed?
is it open or closed, and are you going to give them the money to keep it open? And I think a lot of people are thinking, well, at least the market says, hey, you're probably going to give them the money to keep it open because it's going to cost you too much if you keep it closed.
Probably
So-
we're not going to give it. We're going to have the Middle Eastern countries, all the Qatar, Bahrain, UAE,
Yeah,
and all of
but
that. and
still,
go
it's-
through-
it's money
going
going
to
to
the
the-
Islamic Republic.
Yeah.
What is Iran is going to say? Hey,
Yeah.
we're getting this money one way or the other, and how much they get. And I think that's what they're going to.
Mm-hmm. That's what they're
over.
figuring out, yeah.
Interest rates have come down. They hit this high. We talked about this right about here, and then it just petered out. We're down to about 4.37 today, just right here. Again, as long as we're, this was the island top that we talked about rates.
Mm-hmm.
Came back, filled this resistance right here, and then we just dropped off from there. So
Yeah, it's kind of hard to predict, but once again, what I like about rates, they're going nowhere. And as long as
they
we go
nowhere, we're
we're
happy.
okay. Yeah, we're
Yep,
very happy.
that's the thing exactly. I totally agree with you. Going down too much. Why are they going down? We've got growth is not enough, and that's where we're scared of a recession. That's not good. Interest rates going up too much. Everybody's scared about inflation. That's not good. So right around here, 4.5, we can live with it, and I think the market can live. Gold has been not pretty.
Yeah, I think maybe it's finding a little bit of a low here. It's been coming down, I think, a lot hawkish. I think you're going to get a little bit of a bid here on gold. I think going up. It's been, and you had to work off all that excess. Everyone was selling all their stocks and buying gold earlier this year, and that was it. And then still the long-term trend is up. It all depends on where interest rates go. If
Yeah.
interest rates if oil remains high, interest rates remain high. Kevin Warsh is pretty hawkish going forward, which he kind of set that tone. Then gold's going to be tough to get out of.
We could get the
high.
death cross. Nobody talks about that anymore.
I don't
In
like
the
death.
olden days.
There's no death cross stuff in gold.
Yeah, except in gold. Here's the 50-day moving average breaking below the 200-day. This is the 200-day. The blue line is the 50-day. As you can see, they both converge right here.
Mm-hmm.
If it breaks below this, they call that the death cross.
Well, and this is what we said with commodities. Everyone was saying, "Oh, I need to have a bunch of commodities trade. We should buy a bunch more gold and everything else." Well, commodities, it ebbs and flows with supply and demand. You trade it, but if you're not going to trade it, it doesn't have any cash value. Over time, it can erode, or it's probably not going to necessarily keep up with inflation or specifically the stock market over a long period of time. It acts as a good diversifier. Everyone gets excited for the trade. And that's what you hear even on the financial news. It's more about trades than it is about investing because it's the hot thing. It was Bitcoin, now it was gold, now it's DRAM, right? Trust me, it's going to be something else a couple months from now. And if you buy what's hot at the moment, most likely you're going to be the one holding the bag. So-
Yeah, you've got to differentiate between trading and investing.
Mm-hmm.
I was talking to Vlad last week. He owned Robinhood.
Oh, okay.
Yeah,
Okay.
He's sitting next to me and we were talking, having dinner, and I was talking about our client base, which is investing.
Yeah.
His client base
These traders.
is traders. And he said, you've got to know the difference. And that's really what it is, that you've got to have that difference between the two. And that's really what you have to figure out. Are you an investor or are you a trader? If you're a trader, then sit and trade. It's a full-time job. You can't be trading on your smartphone and thinking, oh, I can do this just on my smartphone.
Yeah.
You got to do it 8 hours a day that you're trading,
you gotta
and then spend 4 hours to prepare for the next day, and then trade the next 8 hours. In 4 or 5 years, you'll break even.
And that's what you used to do. You need to have profit targets, you need to have stop losses, you need to have all these things thought about before you go into a trade. You know exactly how much I'm going to take off at one point and when I'm going to get out. And when you hit there, it happens automatically. You don't get caught up in the emotion, because the more you get caught up in the emotion, the more you're deviating from your model, your system, and the more you're just going to lose money. We say, money plus emotions equals less money. And here at Compact, we kind of have, we have a trading expertise of a background, and we kind of apply, I would say, a trading mindset when it comes to looking at markets. But in the end, we're investing. And so the trading mindset just gives us that ability of when to kind of guide our clients, when to be more aggressive or when to be more conservative. But the core thing that's ultimately driving their portfolio is their risk tolerance, what they're capable of doing, their financial plan, and understanding their taxable liability, all of these things where we can add a lot of value day in, day out for the client. If we sit here and day trade their accounts, yeah, we could probably do pretty well. I've thought about it, but it would take up a lot of time, but I don't think I would have the impact, the positive impact and consistent impact, because you've said it all along. You've seen a lot of broke traders over your 40 years.
I have seen a lot of broke traders, but I haven't seen a lot of broke investors who did the right allocations and stayed with it over a period of time. As I always say, picking tops and bottoms can be hazardous to your wealth. Should be a little sign like there's in cigarettes. Smoking can be hazardous to your health. Trading can be hazardous to your wealth. So don't do it, folks. You can do it for entertainment if you want to. It's like gambling. You go to Vegas, you put $5 on the blackjack table. I don't know if they have $5 table anymore.
They do not.
Maybe not, but whatever, $10 table, whatever it is. You do that, and it's entertainment. It's like going to the movies. You're going to pay a certain price. You're not getting it back, folks. That's the way I try. And if you're going to be a trader, you have to learn. It'll take time. It'll take you about 4 or 5 years to break even, where you lose money, make money, lose money, make money. You make one trade, you make money, and then you make 5 trades that lose money. You make money, and then you give it back over the next 5 trades, and so on and so forth. So it's a learning process. It's a skill set. And remember, if you're trading against professionals who are sitting at their desks in New York, and they've done this for a living. That's what they're doing for a living.
And I mean, you're looking at 2 professionals right here, and we're not trading. So I think that should tell you something.
I've been a trader, folks. I've been there, done that. I've seen just about everything you can imagine in these markets.
Yeah.
You want to create wealth, give us a call. We'll help you
Yes.
get on the right track. That's the important part. Let's look at the HYG, AGG.
Yeah, so HYG, AGG, we saw the relative strength. You can see that yellow line broke down here over the last week. But once again, I always talk about it. Why is it breaking down? Is it breaking down because high yield is breaking down, or because bonds are going up?
High yield is not. It's going sideways.
Yeah, high yield's going sideways. Interest rates came down, so bonds have rallied really since middle of May. Bonds have been doing really well. So that's, we've seen that before, so no worry sign. What we will get worried about is if we start to see bonds continue to rally, meaning interest rates are coming down and high yield is also coming down. If we start to see that over the course of the next couple of weeks, you'll definitely see us change our tone here on market.
You can see in the beginning of February, something happened, where AGG started. The war didn't start until the end of February, but AGG was starting to go up more than high yield.
Correct.
It broke out above. But, since then, the high yield has come back.
But what I like so very different situation there back in March, during the height of kind of the situation when it was breaking out. So you had HYG coming down, but AGG was coming down too.
Right.
And if the market was really concerned that this was going to lead to a recession,
You'd see
AGG would have gone up.
kept on going.
Yeah, AGG would have kept going up. Bonds would have continued to rally because interest rates would have come down, because there is going to be some growth destruction. That's not what we saw. We've seen these episodes before, and it can be painful for bond investors because you're in a balanced portfolio. You're getting hit on the stocks, right? And you're also getting hit on the bonds. As long as you are managing your bond portfolio well, you're not really long-term duration, that's when you can use an opportunity to then buy back your short bonds, or if you have cash, and invest it and lock in these higher rates. And that's
You were
what we've
saying
been
that
doing.
3 months ago. You said this might be at 5%
Yeah.
or 4.8. You were saying exactly is now the time to look at bonds. Remember, you were saying
That's
that.
all. Yeah.
And you know, I hate to sit here and say I told you so, but we told you so. So, you know, folks, give us a call. We'll help you come up with the right plan. We'll get you on the right track, and then, you know, go from there. If you're worrying about your portfolio, you have a problem. So give us a call, 800-388-9700, or just go to invest@compact.com and send us an email or give us a call. We'll be more than happy to help. There's no cost or obligation. If you want to see the charts that we just talked about, those are our thoughts. Those are observations.
That was a long one, 45 minutes.
I know, we talked today a lot.
We're talkers. So.
Yeah, today you know, as I always say, give me a microphone and love to talk. We will be back with you next week. Until then,
Good trading.
This presentation contains the current views and opinions of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.